There are two questions everyone wants to know. Will prices go down and will mortgage rates go down? The median price for single-family homes in August in Rhode Island saw an 11% year-over-year gain. But a lot of people said that prices would go down. In fact, 1 in 4 people still think prices will go down. So what's happening? By the end of this video, my hope is that you will have made your own conclusion. Whether you're a potential home buyer or a seller, or you're just curious about the market, stick with me because I've got a lot of valuable information to share with you in this market update. Hey there, I'm Jess Powers. I'm your local real estate agent here in Rhode Island, and today I've got a comprehensive market update just for you. I'm going to dive into the third quarter. We're going to explore the factors that are shaping our market over the past few years leading up to now, and we're going to discuss what's in store for the future. Plus, I've got some surprising insights you won't want to miss. Once you get to the end of this video, I want you to let me know in the comments what conclusion you've come to. Will prices go down? Or will mortgage rates go down? What is going to happen? So today we're going to talk about 5 data points that every buyer and seller needs to understand when trying to make sense of the current real estate market. You need to understand inventory, equity, mortgage rates, lending standards, and rental prices. So first, let's talk about inventory. I want to break down the distinction between the number of homes available for sale versus the number of homes that are being sold. News sites are talking about how nationally home sales have seen a dip. However, that's the number of homes being sold, not prices. Sales are down because there are less homes available to be sold. That's an important distinction and data that can easily be distorted or misinterpreted. Meanwhile, home prices have gone up, even though many experts forecasted that prices in 2023 would go down. So let's really look at the inventory level of homes that are available for sale. Now, nationally, inventory levels hover around 3.3 months supply, but here in Rhode Island, our inventory levels are even more critically low. We've only got 1.8 months supply in August. A balanced market would be about 6 months. So to put that into perspective, at a national level, the market could easily absorb double the current inventory. So why are inventory levels so low? Well, it's pretty simple, actually. There are 3 main factors at play. There aren't enough homes, there aren't enough new houses being built, people are staying in their homes longer, and many sellers are reluctant to trade a low interest rate that they currently have for a higher interest rate, so they're not selling. Let's talk about homes being built. We have a housing shortage across the US that started back in the Great Recession. There was a 10-year gap where the number of new homes being built was extremely low. Here in Rhode Island, we're very densely populated and we've got limited infrastructure, and that is hindering new construction. We have so many municipalities that are on septic systems and wells, so you can't just build a large development anywhere you choose. Plus, our zoning laws haven't been revised to help alleviate the housing shortage. In fact, Rhode Island ranks dead last in the number of new construction homes being built in the US. Now let's talk about why people are staying in their homes longer. On average, people used to stay in their homes about 5 to 7 years. Now, folks are staying put as long as 10 years. Many are choosing to renovate their homes rather than moving. Now, astonishingly, 70% of homeowners with mortgages have rates that are locked in at those interest rates that are 4% or less. 68% of those folks have paid off their mortgage, or they have at least 50% equity in their homes. That's leading to people staying in their homes longer. It's called the golden handcuffs of low interest rates, and it's playing out right now, but it's a double-edged sword because it's likely that if rates are lowered, they will be more favorable to buyers and sellers, and that will result in even higher prices because you've got more demand. So sellers really need to evaluate how they can best leverage their equity right now. versus waiting. And if you own a home with a low interest rate and you've got significant amount of equity, you may want to consider renting out that home. And it's expected that many will choose to do this, and that will further our inventory issues. Now let's talk a little bit more about equity. Americans have been building substantial equity over the past several years, and despite industry projections, prices have continued to appreciate year over year in the Northeast. In August, our median sale price, like I said, it hit an all-time high of $450, and that was an 11% year-over-year increase. That's a sign of a robust market. So why do people continue to say that prices are going to drop? At the end of last year, 37% of Americans expected prices to drop last year. That surfaces every year though. People are always saying that the sky is falling and that prices are going to go down. 2017, I had buyers that said they wanted to wait for prices to go down. 2019, buyers saying they wanted to wait for prices to go down. 2020, when the pandemic shook the world, major fear that the housing market was going to crash. 2022, when interest rates spiked, the market's going to crash on and so forth. But is that what the data actually is showing us? Many of those industry experts who had previously projected that prices would go down, well, they've revised their forecast, and now they're foreseeing a period of appreciation over the next 4 years. It's essential that you rely on facts. And the fact is that the available supply of homes is nowhere near the demand. And it would take a major economic crisis in order for that to change. Either supply has to majorly increase or the demand has to plummet. And it's highly likely that our government would step in to prevent a major crisis, coupled with the fact that because so many homeowners have significant equity in their homes, even if prices deflated a bit, they would not be underwater. Plus, lending standards are more stringent than ever before. All right, let's briefly talk about mortgage rates. I wish I had a crystal ball, but even experts, they've had a hard time and have had to reevaluate their expectations. Rates remain uncertain, and inflation, it just hasn't gone down as quickly as we had hoped, and that has resulted in rates continuing to rise. Again, it is so important to look at all of the details together in order to get a clear picture of what's happening right now. It was forecasted that rates would peak this summer and that rates would go down this fall, but so far that's just not what has happened. Will they go down next year? Well, historically, during election seasons, rates historically go down, but this upcoming clown show, who knows? Anything goes. All right, but what if rates reach 8% or higher? Now, interest rates can certainly cause the market to soften or even slightly deflate. We saw that last summer when rates spiked, but once buyers accepted that the 6 to 7+ interest rates were the new normal, those that could still afford the monthly payments, or those that didn't even need a mortgage, they continued to buy, and therefore prices have continued to increase. 8% or higher, that would likely cause the market to pause. Those who have to sell, they could probably see their prices go down a bit, but the market, it actually would most likely become a stalemate. All right, I've got 2 more data points to consider: mortgage lending standards and the rental market. Mortgage credit availability is extremely stringent now, unlike the early 2000s when just about anyone could get a loan. Those lax standards were one of the main factors that led to the housing bubble. Literally anyone could qualify for a loan or even multiple loans. No credit checks, no employment verification, loopholes for those with low credit scores. That's just not the case for today's lending standards. And foreclosure rates in the US, they spiked in 2010 at 2.8 million filings. Mortgage fraud, subprime mortgages, what a confluence of predatory lending standards that led to such a significant amount of people losing their homes. It led to a massive amount of available homes on the market. Inventory, it's the exact opposite of what we're experiencing now. It's so important. You've got to look at all of the details together in order to get that clear picture of what's happening. Compared to a decade ago, we have more stringent lending regulations. We have people with significant amounts of equity in their homes. We've got very few people who are delinquent on their mortgages. Now, I hope you see from the information that we're discussing, the low inventory due to lack of sufficient homes being built, people staying in their homes a lot longer, folks with super low mortgage rates waiting to sell or deciding to rent their house instead of selling, lending standards that make it much more difficult for people to qualify for loans, and the low number of foreclosures and delinquency rates, all that comes to the conclusion that most are leading to, myself included, that inventory is going to continue to remain low and therefore prices are continue to rise. Now again, we could easily absorb double the inventory. All right, but wait, we have one more metric to look at. Let's talk about rental prices. Why? Well, if you're not going to buy real estate, then you're going to look for a rental. So let's quickly talk about the rental market. Let me tell you a little story. My first apartment in Providence was this fabulous 3-bedroom apartment in the Armory District of Providence. I rented it for $600 a month. Now, 20 years later, and that same apartment now rents for around $2,500. Now in Providence, the average 2-bedroom apartment is on the high side of $1,800 and quickly inching up. If rental prices were still $1,200 or lower, then we would likely see more buyers opting to continue to rent. That would certainly lower the demand side of the equation. But with rents on the rise, renting as a long-term solution, it just is less appealing. That's why 27% of current buyers are first-time home buyers. Renters who are waiting for prices to come down, well, that could mean another $24,000 or more towards someone else's mortgage. 4 years later, and they've spent nearly $100,000, and there's zero return or equity on that money. It's a cost analysis every renter needs to consider. Now, it's not my job or my intent to convince someone to buy or sell real estate. My job is to serve as a guide and to present the data to help my clients make informed decisions. And data is localized. So while these national, regional, and statewide numbers are important to be able to understand, you also have to really look at what's happening in a detailed, very specific, localized level. The right time to buy, it's when the numbers work for you and when they align with your financial goals. If you try to time it based upon what a news outlet tells you or your Uncle Bob's opinion, well, then you're likely going to miss opportunities that could have been right for you because you misunderstood manipulated data that was aimed to scare you and sell ads. So I want to know what you think. Post it in the comments. Will prices go down? Will mortgage rates go down? What do you think is going to happen in the real estate market? Now, thanks for tuning in to this market update. If you found this information helpful, then share it with your friends and family, and don't hesitate to get in touch with me with any questions that you have. Now, my name is Jess Powers, and I'm always here to help.